Dipan Mehta joined just now. Dipan, good morning. Thank you for joining us. What do you make of the market setup? Just when we thought that all the event risk is behind us, markets should fly. The price action yesterday in the mid and small cap stocks was not that encouraging. I mean, Dipan, I look at the market and I say, okay, whatever markets were nervous about, Trump tariffs, budget, MPC, earnings, the events have panned out much better than what the fears were.
Jacoban Nikunjan, thank you for having me on your show. See, the essential issue here is slowdown in the GDP and slowdown in earnings and high valuations. And all of these events do not change that particular aspect significantly at all. But I think with every passing day and every 100-point fall in Nifty, I'm getting more and more hopeful, optimistic, positive. I've been negative on the market for many, many quarters. But I think that for one, I think a lot of valuations are now getting into the reasonable zone after such a steep correction. And we are seeing some improvement, at least in terms of, this turnaround which we are seeing, the slowdown is definitely slowing down, I would say. And we are seeing some improvement over there also. And especially the budget has been very good. And the cut in interest rates, I think these are steps taken in the right direction to avert a further slowdown in the GDP and corporate earnings, and that get reflected in better performance over the next 2-3 quarters or so. So I'm not as negative as I was maybe a few weeks or a few months ago, but it's not that we're out of the woods. We can still see a further correction, but on a fundamental basis, I think things will stabilize pretty much soon.
Okay. So what is the best way to wade this kind of an volatility? Just sit through it, shuffle your portfolio.
See, first of all, Nikunj, this volatility and this correction which we have seen is really a walk in the park. I mean, it's so easy to handle and manage. And if you've been in the market long enough, you have to anticipate that you will see these kind of period as well. Market doesn't go up one way all the time. You have these corrective periods, and they are excellent in terms of understanding which stocks you have bought, correcting the mistakes, reshuffling your portfolio, getting the balance right. So from that point of view, I don't think investors should be perturbed at all. And this is basically a learning experience for new investors and for old investors like us. I think, as I said, it's something which we take in our stride. And coming specifically to sectors, I think that, where stocks, rather than sectors, let's look at stocks. Stocks which are expensive and earnings don't come through, those have to be sold even if they've corrected by 30-40% or so. And other than that, I think in this earnings season, look for gems, companies which have surprised on the positive side, and look at buying them at reasonable valuation. That should be the strategy.
Interesting. Dipan, hi, morning. So where is it that you're finding those opportunities wherein the valuation is now comfortable after the recent bout of correction and there's still earnings growth?
See, of course, that is one investment theme to follow, but also the fact that consumption will definitely improve post the kind of tax reliefs which have been given to the middle and lower income. From that point of view, very positive on companies which are engaged in non-discretionary spending, like appliances, like air conditioning companies. I thought Blue Star, Voltas, Amber, EPAC all came with very good set of numbers. And definitely, I think each summer is getting warmer than the previous one. So we are positive on that sector. You could add even Symphony to that, India's largest air cooler company. Again, disclosure, we and our clients are invested in it. Even other appliances, I think, should do very well, considering that it's kind of a discretionary spend from that point of view. Travel and tourism looks interesting. We saw what is happening in Indian hotels and a lot of other hotel companies. I thought Lemon Tree came with a very good set of numbers, and they have a fabulous expansion program in place, largely through management contracts, which will be very highly earnings accretive as well. Indian Hotels also has delivering a very good set of numbers and very aggressive expansion plans. I even like numbers which came from Indigo, the airline company, India's largest airline company. If you remove the kind of damage which has been done by forex losses, the underlying growth is pretty much intact, and they're also expanding their capacity. A lot of it will come into stream over the next 12 months or so. So like that, I think there are lots of pockets. From a safety point of view, I think insurance, pharmaceutical companies also, I think, are worth analyzing and being overweighted. So I think if you go from sector to sector, you will find many interesting stories, interesting stocks which have now come at reasonable valuations, and where growth, I think, can still be above that 15-20% kind of a benchmark, which is the minimum criteria from an investor's perspective.
Okay. Cipla 1458. Actually, some of the pharma, Dipan, will it be suffice to say that pharma really has been the hit of this earning season?
Absolutely, Nikunjan. It's not just this earnings season, it's been the best performing sector for the last 12 months. Last 2, 3 quarters, the numbers have been very impressive. We are seeing slight structural changes when it comes to competitive intensity in the US generics market. The overall compliance track record of the industry certainly has improved. I think a few years ago, we could easily see a pharma stock being down 10, 15, 20% because of some action taken by the US FDA. All those events certainly have come down. So I would say compliance has improved. A lot of Indian pharma companies are focusing on the domestic healthcare sector also, which is very robust. Does generate the kind of double-digit type of growth rates because healthcare spends within India are improving, medical facilities within India are improving. So you're bang in the middle of that particular phase as well. And I think globally also Indian pharmaceuticals are gaining market share and our competitive edge is clearly playing out. So it's one sector definitely one should be overweighting. And there are so many categories within it. There's large pharma, there's CDMO, there are companies focused on domestic formulation, there are the API players. And surprisingly, if you see in this earning season, across the board, all of these sub-segments in the pharma industry have done well, including APIs.
Okay. Dipan, in this fall, there is one group which is still the high growth space, which is platform companies. They have also corrected. Zomato from 300 came down to 210, maybe 230 right now. Similarly for Policy Bazaar and also for Nykaa. Can one say that in this fall, instead of buying value, which is typical PSUs, power, utilities, don't buy them because that's a bet on economy. Buy high growth, which is a bet on discretionary spend, which is a bet on new India, which is a bet on technology and efficiency and productivity.
Yeah, Nikunj, I would agree with you. I would absolutely agree with you that in your portfolio, you have to have a balance of these new age businesses as well. And if you look at the corporate earnings, I think all of these companies which you named have been following through. They have been reporting top line, bottom line as per street expectations. And now the valuations, whether you take price to book or earnings per share, price earning multiple or EV to EBITDA, all of those multiples certainly have come down. So I think investors who do not have adequate exposure to these platform companies, new age businesses, should certainly take this opportunity and invest in these companies. But look, you have to have the right kind of a mindset and more importantly, time frame. Because if this correction phase lasts for some more time, then you may see more fall in these stock prices. At the same time, I think the returns, to expect good returns, you need to have a holding horizon of at least 3 to 5 years or beyond. But I agree with you that these are great companies. They have proven their business model. They can scale up really well. They have great operating leverages as well. So one should have a few of these in their portfolio. And I would say that look at some of the profitable ones as well. I mean, I know companies like India Mart. There's another company, I think Zaggle Prepaid, which reported slightly weaker earnings, but very good business model. And then there is Affle India, very impressive set of numbers which came through for the December quarter. That's also a platform company into advertising. So like that, I think there are a few, I would say, highly profitable platform type of business companies. And one could focus over there. And of course, there is Zomato and PB FinTech, which I think also merit a look in from an investor's perspective.
So Dipan, by Saturday, when Prime Minister Modi is back, we pretty much would know that which way the tariff regime is moving for India. So far, there is no restriction on India. So far, the tariffs have been on expected lines. They are much lower than what markets were anticipating. They are not something which, in a sense, is going to have very damaging impact, at least to Indian exports per se. So I wonder what is the fear all about, because every time I speak to FIs, they are saying, "Arey, tariff aa raha hai, tariff aa raha hai. Dollar upar hai, dollar upar hai." The reality is different.
You're right. You're right. I disagree with you that you won't come to know the end game of these tariffs so soon. Because even after the visit of Prime Minister Modi, then nothing stops them from imposing tariffs across the board 1 month from now or 3 months from now. I think this is going to be a hanging sword for many, many months. And more than anything, I think, you need to recalibrate your strategy because export-oriented businesses may get impacted. For example, I was very positive on textile manufacturing exporting companies like Gokuldas, PDS, and we had Kitex. I think they all reported very good set of numbers. But now, there's a bit of a cloud over there. What if tariffs are imposed on export of Indian textile, be it home textiles or apparels? That certainly could impact the performance of these companies. So just need to recalibrate your investment strategy and focus on, as I said, the real theme to focus on is discretionary consumption space within India. The capex cycle also certainly may improve as execution improves. So we have, I think, enough investment themes to look at within India. And I don't think that from that perspective, tariffs is going to play a major role. But what happens is that when tariffs do come through the way they're talking, it affects all the global markets, and that just impacts the sentiment over here. I mean, when you see Dow Jones, Nasdaq, S&P, and all dropping the way they do abroad, there's a sentimental impact on our markets as well. So that's just one point to be noted.
Talk about the global setup. Globally, while we are talking about tariffs, globally, while we are talking about the impact of tariffs, frankly, US markets are stable, uneasy, calm, or calm before the storm, or base building. That only time will tell. But for me, the handover from US markets, I think, is decent. Second, Asian markets, especially China, the word steel and aluminum, in principle, now the tariffs have been rolled out. Chinese markets are not really shaky, or they're not really whittling. Let's see how European markets open, because Russia is also a large exporter of steel, and steel tariff in a sense is a problem there. Now there are a few Indian companies which have not a large presence, but they have a presence in US. One of them is actually JSW Steel, second is Welspun. For them, then the third I think is Hindalco, which has a presence via Novelis. So these are some other stocks which in a sense sentimentally could actually see some price action. But again, it goes back to the point which Dipan just flagged off, which is that understand the root reason. Markets are down because valuations were expensive and the economy is slowing down. We can supplement it with this event like risk, like budget, MPC. We need to understand that will the economy recover from this slowdown and where valuations have corrected. So I'll repeat myself, Dipan. We've identified the root, which is that markets are down because earnings are slowing down and valuations were high. Where do you think the earnings slowdown will be prolonged? Which is that don't buy them. This is a structural to a multi-year slowdown. And where do you think this is a cyclical slowdown where after 3 quarters, maybe another quarter, but things will start looking up?
So I think the consumption space, I think definitely they were impacted by cyclical slowdown, lower consumption spends, and even inflation. But so that I think we'll see the first recovery. A lot of the retail companies, discretionary spend companies, I think you should see an improvement in their performance. I think even capital good manufacturing companies, they have reached reasonable levels of valuation and they have good order book visibility. They should do well. Structurally, I think, as I said, I think commodities by and large, we have been underweight and would like to remain underweight. Companies like cement and all, I think sectors like cement, you may see an improvement in the earnings, but the kind of competitive intensity which is there and the inability to pass on cost increases, I think those are the factors that are going to play much longer. And there are secular problems, according to me, within the commodity companies, be it cement, steel, aluminium, which kind of need to be avoided. And lastly, I think, Nikunj, we haven't spoken about banks. And although I think banks in this calendar year may do very well because of RBI action, liquidity improvement, and tapering off of NPAs. But when I take a 3-5 year view, I want to be underweight banks because really it's getting into a very, very competitive kind of a red ocean scenario. And the banks, there's hardly any differentiation in their business models. And there's just far too much competition and too many banks. So from that point of view, on a medium-term basis, like a 1, 3, 5 year type of outlook, I want to be underweight banks. But I think tactically, the next 6 to 12 months could be very good for the sector.
Dipan, does it make sense in this market right now to make those market cap based calls, steer clear from small and mid caps, have a larger concentration to large caps? Or would you say just go be stock specific, measure the valuation, earnings growth and visibility?
I think both strategies are fine, but when you look at the kind of stocks you want to invest in, you will generally find that the risk return profile of the large cap stocks is far better than the mid cap stocks. And in markets like this, I think investors who do not have adequate exposure to large cap will see even further deterioration in their returns. So I would say that incremental flow should go into large cap stocks, but it's not something that a must do. It's important to do a bottom up stock picking strategy, but even over there, you will find that the large cap stocks valuations are still are at reasonable levels compared to the growth rates. You won't find multi baggers over there, but I think that if you look at a 12-month type of a perspective, you would be able to get stocks in the large cap which will at least deliver 15-16% type of a return, which I think investors should be quite satisfied with, given that we have had last 4 or 5 years have been phenomenal in terms of market price performance.
Interesting. Okay, Dipan, we'll let you go on that note. Thanks as always for taking the time out and joining in.